Welcome to today's deep dive. We're tackling a massive collision of events today, specifically tailored to the topics you've asked us to explore. Our mission: to analyze the accelerating enterprise-level financialization of digital assets against a backdrop of, severe global macroeconomic shifts over just the past 24 hours.
Yeah, it is a lot to unpack.
Right. So here's the question to anchor us: why are corporate treasuries hoarding digital assets, while the traditional industrial base is, well, quietly shifting to a defense footing?
Well, the catalyst for that shift is entirely fiscal. I mean, a drone attack just bypassed defenses at a UAE oil facility in Fujairah. And when terrestrial energy infrastructure takes a direct hit, the immediate fallout is an energy supply shock.
What spikes inflation?
Yeah,
right?
exactly. It spikes inflation, which effectively handcuffs the Federal Reserve from cutting interest rates to stimulate growth.
I get the macroeconomic tension there. I mean,
Yeah.
energy costs are up while U.S. factory orders just jumped, but they're heavily skewed toward defense aircraft rather than, non-defense manufacturing.
Yeah.
But I have to push back here.
Go ahead.
How does a drone attack and factory retooling directly force a reaction in digital asset market telemetry today? I mean, that feels like a massive leap.
It does seem like a leap, but it's really about how institutional capital protects itself from that exact inflation and geopolitical risk. Instead of fleeing to cash, we're seeing massive capital flows entering spot ETFs.
Right, especially BlackRock's IBIT fund.
Yeah, exactly, which is driving Bitcoin past the $81,000 mark.
Even so, the derivatives market looks incredibly volatile right now. Traders are paying a premium to hold long positions, which means funding rates are, skewing positive.
Right, which creates this sort of powder keg mechanism. When traders are highly leveraged, betting on the price going up, and spot prices push past key psychological boundaries, we see severe short squeeze potential.
Because capital is aggressively positioning for upside.
Yeah, because macro instability is making traditional fiat positions look much riskier.
So the assumption might be for you listening that institutions are just buying these assets to hide them under a digital mattress, to weather the storm.
That's what you think initially.
Right. But looking at corporate balance sheets, mining companies and data centers are holding billions in Ethereum and staking it for protocol yield. Then you have legacy transfer agents like Equiniti, who manage capitalization tables for thousands of corporate clients, getting acquired by digital asset exchanges. Are these massive corporate maneuvers just desperate yield chasing in a high inflation environment?
Yield is a secondary benefit, really. The primary driver is pure utility. Wall Street is, they're completely rewiring their settlement plumbing. Consider that the SEC recently granted a regulatory safe harbor to a platform called HQLAX.
HQLAX, right?
Yeah, they've built a monitored sandbox for highly capitalized banks to use distributed ledgers for securities lending. So instead of physically moving assets, which takes days and carries settlement risk, they're using digital collateral records.
Essentially, traditional Wall Street is aggressively downloading a new operating system.
That's a great way to put it.
But you can't run Wall Street's new digital plumbing if the underlying blockchain takes days to settle. I mean, it defeats the entire purpose of escaping legacy settlement times.
Which forces an immediate software architecture upgrade. We're actually seeing this right now with Coinbase's Layer 2 based network rolling out what they call the Azul upgrade.
Oh, the shift away from optimistic rollups.
Exactly. They're abandoning optimistic rollups in favor of zero-knowledge proofs, which are processed by a cryptographic engine known as the SP1 virtual machine.
Okay, let me test an analogy here to make sense of this shift. If an optimistic rollup is, say, like depositing a paper check where you trust it will clear unless the bank flags it as fraudulent a few days later, are zero-knowledge proofs more like handing over mathematically verified digital cash that settles the instant it changes hands?
That's close, but the distinction is actually even more rigorous than physical cash. I mean, optimistic rollups fundamentally require a multi-day challenge window to give network participants time to catch cheaters.
Right. That makes sense.
But zero-knowledge proofs use advanced cryptography to prove a massive batch of transactions is mathematically valid at the exact millisecond of execution. There's no challenge window because, well, the math just cannot be faked.
Wow. By eliminating that multi-day delay, they're giving enterprise capital the absolute cryptographic finality it demands to move billions of dollars daily without counterparty risk.
Exactly. So the analytical through line becomes undeniable here. Global macro instability and rapid industrial defense mobilization are acting as direct accelerators.
Yeah.
The traditional finance sector is adopting zero-knowledge blockchain-native infrastructure because they absolutely require speed, security, and finality in an increasingly fractured world.
The physical world braces for conflict, and the financial world fortifies its digital rails. Which leaves you with one final thought to ponder as we wrap up today. If highly regulated traditional transfer agents, massive corporate treasuries, and defense-mobilized economies are all independently accelerating their move toward distributed ledgers,
It's a massive, undeniable shift.
what happens when a sovereign nation decides to entirely tokenize its defense supply chain on a public network? The timelines of physical reality and digital liquidity might not just collide, they might merge entirely.